Good morning, everyone. I'm going to take a good look at gold and also at stocks in general. There's a couple of key signals that are starting to come through. So I think we're at a very interesting point in a lot of markets. So let's have a look at, start off by having a look at stocks. The S&P index ended up losing 9 points on the week. Um, and in terms of shorter term trading, it's in a band, as we'll see in a minute, and could really break either way. But there are signs of broad market weakness, and this has really been the first week that I've been able to say that. Up until now, there's been lots of people calling for the S&P to roll over, but there weren't really any signs, and there still aren't, to be honest, on the S&P index, but certainly on some of the other indices and indicators there are. So it bears having a close look at those. One of the other things that's occurring is that some of these just stupidly overpriced IPOs in some of these new technology stocks that are priced at incredible multiples and earn virtually no money. Those IPOs are starting to fail, and that's generally a sign that you're getting close to a top, at least in that section of the market. And we're also seeing some stupidly overpriced other stocks. Now, regular viewers of this weekly video will know that I've been saying for a long time that there are extremes in the American market. We've got stocks that are stupidly overpriced, like Facebook and Twitter, but we've also got a lot of extremely good value stocks in America. Really good solid businesses with terrific earnings growth, and they're priced at attractive and below fair value levels. So there's a real mixed bag there in America. Now, if this develops into a correction, and I believe there's a much higher level of probability now that that would happen, and this is certainly the right time of year for that to occur, then we're looking at multiple targets anywhere from 1678 through to 1792. So it's a pretty broad range, and it would depend on how that really unfolded. And of course, the other thing that I want to take a look at is the bond market. It's showing some early signs also of breaking out, which would not be good for stocks. So let's take a look at some charts. We'll start with the S&P index. So you can see that short term, we've got a range that's developed here between around 1840 and the all-time high at 1885. So it's this little segment here. Now you can see at the moment the 150-day moving average is still heading up very strongly. There's no sign of weakening there, and the S&P index remains significantly above that index. So you've got to say that the S&P index is still in strong uptrend. However, we are getting a bit of an extended top now. I'll just move that out of the way so you can see it more clearly. All these other previous peaks before the market went into a bit of a retracement and then kicked on further were fairly brief. We're now starting to get a series of running tops, or a multiple number of tops and a range forming, which could be the preliminary indicator that the market is getting a bit tired. So that's the first indication. But if you want to know which way the S&P is going, then watch that range between 1840 and 1885. A break either way will tell us quite a bit about what's going on in the market. Now let's look at the Nasdaq. The Nasdaq index quite often will be a leading index for the market in general turning down. And you can see here for the first time we've actually broken down through a previous peak, and we've also, which was here in January, and we've also broken through a previous little pivot low, which was in March. So it may well be that the Nasdaq is changing character. So let's have a look at that Nasdaq. You can see it's been an enormously strong uptrend. It's still not to the 150-day moving average, so none of this is panic stations by any stretch of the imagination. But there's just a few indicators there that we could be close to the beginning of a bit of a change in characteristic in the market. Let's have a look at the broad Russell 2000 index. Similarly, we've In fact, that's the ETF. Let's look at the actual Russell 2000 index itself. So you can see we've also done the same thing. We've broken below these highs of January, and we've also broken below the pivot lows of a few weeks ago. But still, you've got to say, still pretty robust. But in terms of positioning, you certainly need to be thinking about what could possibly be around the corner. Let's have a look at some of the really hot, overpriced stocks in America. Now, there's not much data here. This is Twitter. I forget what price they IPO'd at, but you can see very quickly the price got up to $73 in December, but now it's trading down at 46. So that's been an enormous loss in a short period of time. Let's have a look at Facebook. This is the price chart for Facebook. Also, it went from around $18, got up to 72, but has backed off very sharply. It's come back to 60 in the last week. And finally, let's look at another tech stock, Netflix, online movies. And also, too, it had run very hard from $60 to $450, which is just crazy stuff. And now it's come back $100 in the last week and a bit. So certainly some signs there that that the American market may be starting to look a little bit tired. Let's have a look at the bond market. This is just one of a number of bonds ETFs that we could look at. You can see here that bonds basically have been in decline for some time, which is what you would expect at the end of a long bull market in bonds. But we have formed this phase one base. Now, it's possible that this isn't a breakout. It's only very, very preliminary at this stage. You can see on Thursday, just popped its head above these previous highs, and just the possibility we could break into a phase two bull market. Now, if that happens, what that means is that people are buying bonds, and therefore money is coming from other places. And one of the other places that the money's coming from, of course, is the equities market. So if people start buying back into bonds again, then money's going to be coming out of equities, that's for sure. But look, that's not conclusive yet. It's possible that the bond market could just go back down again and ultimately break out of this range to the downside. This could just be a consolidation pattern in an ongoing downtrend. And if that were to be the case, then that would be positive for stocks because it would indicate that that people are selling bonds. So that's another key indicator to keep an eye on. Now let's have a look at the Australian market. This is the ASX 200. It's been a lot weaker than the American market, but you can see the red line, the 150-day moving average, still heading up. The price is still reasonably above it most of the time. We've got a long-term support trend line here. The price of the Australian index is still well above that long-term trend line. But what I'm trying to do in my message this week is to identify the early indicators. I mean, if you wait until these trend lines get broken, then there's been a lot of damage done in the stock market by the time we get to that point. Good trading is about positioning yourself in advance, protecting your capital, and positioning yourself for the next phase in the market. And that's really what I'm trying to signal with this week's video update. So the Aussie market, we ended up gaining 28 points on the week. That was really just a bit of a timing thing with what the American market did on Friday and how our market responded on Monday. Again, the banks were the best performers in Australia. But the small cap sector is definitely showing some signs of weakening. So the money flows are changing. The volumes are dropping away. The market depth in the small caps is dropping away. So money is not as enthusiastically in our market as it was before. So that means if the US market does break to the downside, then thin liquidity in Australia is going to see stock prices fall in the small caps pretty quickly. And that's why you need to move early. If you wait until a correction happens, then you find you would have done a lot of damage to your portfolio by the time that occurs. Now, the Aussie dollar strength is a real mystery. If things are really as fragile in China as a lot of people are saying, and some parts of the market are reacting, then why is the Australian dollar going up? Why has it gone from 87 cents to nearly 93 cents in the last few weeks? Those two things aren't consistent. So that's going to be an interesting dynamic to watch as well. Now, gold lost another $39 on the week, and I want to have a good look at gold. It's retraced 50% of its prior gains, and it's still within its phase one base. So it raises a question, which way from here? Again, long-term viewers will know that I've been pretty bullish on the long-term prospects for gold, but that is long-term, and I'm open-minded to the fact that we may not be ready to break out in gold just yet. And we've also seen a similar move on the GDX as well. And we also saw silver fail back into the trading range. So let's have a look at those few charts. First of all, this is the chart of gold. In fact, I'll go to a cleaner chart that will give us a little bit better view of what's happening in gold. This is a weekly chart of gold going back to 2005. So you can see the enormous run up that we had for nearly a decade in gold. The purple line here is the 30-week moving average, which is the same as the 150-day moving average. So you can see we've had a significant phase three. So the accumulation section through, or the distribution section through here. Then we got into phase four, and we've now dropped back into a phase one pattern. Now you can see on the big picture level, it almost got back to the 61.8% retracement was at 1155. We hit a low of about 1180, so pretty close. We also formed a double bottom here in June 2013 and again in January of this year. So if we highlight the trading band that this is in currently, so you can see clearly gold is in a trading band, but for the first time the price of gold has started to break back up above the moving average, and the moving average has now turned flat. However, it's or let me back up one. I think the big picture fundamental drivers are for gold to break to the upside and resume its uptrend. However, could we go and retest the bottom of this range in gold? Yes, of course we could. Could we get a false break to the downside and get down to this 1155 level? That's possible as well. So I think it's, whilst there's been some really good gains in gold stocks in particular, we've had a number of gold stocks double in price in the last few months. You've got to keep gold in perspective, or gold stocks in perspective. This is still a phase one. We are not yet in phase two. Gold and gold stocks could return to the bottom of this trading range. So until we get more clarity about what's happening, then you need to play gold stocks with a degree of caution. Now let's have a look at the silver chart. So this is silver chart on a daily basis. You can see we had really quite a tight trading band through here. We broke above that trading band with quite a lot of momentum to the upside, but that momentum then stalled and we're now back in the range. Silver's getting a bit oversold, but yeah, it's not really what I wanted to see. I really wanted to see silver hold above this breakout zone and then push up from there. So precious metals markets really they've lost momentum since the Fed made the announcement that interest rates may start rising sooner than 2016, which had been their previous target. As soon as they made that announcement, gold and silver have just completely lost momentum. And now finally, just looking at the GDX index. So it's the same sort of pattern on the GDX. We've had a move to the upside, but still within the overall phase one base. So the GDX index moved from $20 to $28. We've now retraced exactly 61.8%. Is this the bottom? Well, we won't know that until a few weeks' time and see how things trade. But the message is, yes, there are some good gains to be made in gold stocks, but the really big gains will occur on the breakout. So just be a bit cautious about how you play that at the moment. Now, copper was stronger. It's a good bellwether for the state of the global economy. Copper stronger at $3.02, and also crude oil was stronger, back up to $102 a barrel. This is the spot copper chart. You can see we've spiked back up again just in the last week. Now this is the same slide as last week because nothing has changed in that period. So April, May tends to be a seasonally weaker time of the year. Not always, but mostly. We are seeing signs that the markets around the world are starting to lose momentum. So it's a case of protect your capital first and foremost. My recommendation would be to start to free up some cash. Members, of course, already know through our other communications that that's what I've been recommending. Free up some cash. We're now going to be really highly selective about what we buy. Gold stocks still building in phase one. And the real explosive move is when you can make your money. So you need to be taking a longer term view of gold. And this sideways band could continue for some time. So we're at an interesting time in the market. And there's certainly the potential to position yourself to make some terrific gains, because what we've seen in the last 18 months is that the really good stocks, when they pull back, if you can buy them on the pullback, if you can buy them after corrections, you can make some terrific profits very quickly. If anyone wants more information on what we do for non-members watching this video, then that's our website, which explains the various services we provide. And if anyone would like to contact me directly, there's my email. Always happy to respond. That's it for this week. A little bit longer than normal, but I think we're at a very key point in the market, so it was worth going into a bit more detail. That's it for now. Cheers.